Hello, and welcome to the NCUA's webinar on credit risk management. I'm Nagi Khaled, Associate Director in the NCUA's Office of Examination and Insurance, and I'll be your moderator today. Before we begin, I will cover some technical tips to ensure that you can see the webinar console and hear the presenters. First, all attendees will be in listen-only mode. Second, if you have any questions, you may submit them at any time using the Q&A feature at the bottom right corner of your WebEx console. To submit a question, simply click the Q&A button, type your question in the box provided, and then click Send. Third, if your volume sounds too low, check to ensure your volume is turned all the way up on your computer. If that doesn't work, you may need to plug in external speakers. Fourth, closed captions will be available within the WebEx console. To enable captions, click the CC icon located at the bottom left of the console. Additionally, the information and views expressed in this presentation are intended for informational purposes only, and as such are not formal opinions nor binding on the NCUA or its examiners. Furthermore, this presentation should not be construed as regulatory guidance, but rather as a potential resource that outlines risk management practices that credit union boards and management teams may wish to consider. With that, I would like to start us off with some opening remarks from NCUA Chairman Carl Hauptmann.
Thank you. Hello, everybody. Welcome. Thanks for taking time out of your day for this credit risk webinar. Everybody here today knows what credit risk is, since it's the oldest risk out there, the risk that somebody might not pay you back. Credit risk is one of NCUA's supervisory priorities for this year. I hope that today's webinar is helpful to you as you think about the environment you're operating in. And as you think about the risks applicable to your credit union, you may be interested to know that NCUA's examiners have observed trends in declining capital levels, rising delinquency rates, and lower earnings across the system and at specific institutions. Lending credit risks are the foundation of most credit unions. At the beginning of this year, delinquency rate and rolling 12-month net charge-off rates for used vehicle loans were the highest on record. The rolling 12-month net charge-off for credit cards exceeded the peak during the global financial crisis 15 years ago. NCUA continues to see signs of strain on balance sheets, particularly consumer stress. Our examiners will continue to review credit unions' lending and risk management practices. We'll review loan underwriting standards, collection programs, allowance for credit losses, the reserves, charge-off practices, etc. Although inflation has retreated in the country in general, higher price levels along with higher interest rates have continued to strain household budgets. Delinquency and charge-off rates have increased well past their pre-pandemic levels, and again, in some cases, at levels we haven't seen in over 15 years since the financial crisis. We're watching this closely, and I'm confident the credit unions can navigate these uncertain waters. They've done it before. All that news about charge-offs and delinquencies can be daunting, but I encourage credit unions to continue to take well-managed risks in order to serve their communities. Even with rising delinquencies and charge-offs, originations remain strong in areas like auto lending, lines of credit, personal loans. Credit unions continue to lend where it matters most, helping members in volatile times. Today's webinar should be helpful to credit unions of all sizes, and I appreciate you taking the time to join us, and I'm eager to hear what kind of questions you may ask my colleagues. With that, I turn it back to you, Nagi.
Thank you, Chairman Hauptmann. Our agenda today will start with an overview of lending trends, loan performance, and the credit risk outlook of the credit union industry. We will follow that overview with a discussion on common examination issues and corresponding best practices for credit risk management. The presentation will conclude with a brief discussion on credit risk governance, and then we will open it up for a Q&A session. With that, I'll turn it over to Senior Credit Specialist Jessica Yam.
Thank you, Nagi. We're going to start today's presentation with a discussion on lending trends, loan performance, and the credit risk outlook for the credit union industry. Next slide. This graph shows the rolling 12 months asset growth and loan growth for federally insured credit unions over the past 20 years. You can see significant variability in assets from year to year with the solid blue line through 2019. But the historical range has generally between 0 and 10% through 2019. However, during 2020 and 2021, the credit union industry experienced very rapid asset growth, due in part to stimulate efforts and assistance programs that were implemented in response to the pandemic. This significantly increased liquidity in the system was followed by rapid loan growth, as reflected by the orange line with the markers during 2022, as that liquidity was deployed into loan portfolios. Next slide. Moving on from loan growth, this graph shows the delinquency rate with the blue solid line and the rolling 12-month net charge-off rate with the orange dashed line for all loans held by federally insured credit unions over the past 20 years. Loan performance began to deteriorate during 2022, which continued into 2025. The rapid deployment of the liquidity into loan growth during 2022 means that the underwriting standards that were in place during 2022 are having a disproportionate impact on loan performance. Loan delinquencies are cyclical and typically peak at the end of the year. The 2024 year-end delinquency rate peaked at 0.98%, which was the highest point since the end of 2013, when the industry was still recovering from the global financial crisis. The rolling 12-month net charge-off rate was 0.81% as of the first quarter of 2025, which was the highest point since mid-2012. Next slide. Some of the adverse loan performance trends are being observed within unsecured loans and credit card portfolios. Credit card balances currently represent approximately 5% of the total outstanding loan balances, while the rolling 12-month net charge-off rate, the orange dashed line on the chart, for credit cards stood at 5.2% as of the first quarter of 2025, its highest point in the last 20 years. The interest rate on credit cards may still mitigate some of the risks to earnings and capital, but the deterioration in performance points to increasing financial stress for many credit union members. Next slide. Vehicle loans have historically been a core part of the credit union loan portfolios and currently represent approximately 29% of the total outstanding loan balances. We are seeing some signs of deterioration in vehicle loan performance metrics. New vehicle loan performance, represented by the two lines with markers, is largely in line with pandemic performance levels. However, the rate for used vehicle loans, the two smooth lines on the chart, are at 1.16% for delinquency at year-end 2024 and 1.11% for net charge-off as of first quarter of 2025. Both are the highest point since 2014, when more detailed data began to be collected. Next slide. Last but not least, in this section of the presentation, we have real estate loans. Due to changes in the core report, the data through 2021 contains all real estate loans, including residential and commercial real estate loans. Subsequent to the core report changes, the data in this graph relating to the real estate loans only include residential real estate loans. While this complicates the trends, commercial real estate loans are a relatively small portion of the overall credit union industry loan portfolio. Therefore, the trends are still relatively clear. Residential real estate loans currently represent approximately 46% of the total outstanding loan balances. Delinquency rates are increasing within the real estate loan portfolio. The delinquency rate for first lien residential real estate was 0.5%, and the delinquency rate for other residential real estate was 0.7% as of the first quarter of 2025. However, the loss rates are effectively zero at an industry level. Next slide. The key takeaways here are that we are not simply seeing a reversion to the mean for loan performance. Loan performance metrics generally indicate higher credit risks than we have seen within the last 10 to 12 years. However, that risk is not evenly distributed across all loan types, with some portfolios experiencing more deterioration than others, such as credit card portfolio and the used auto loans. With that, I will turn it over to Senior Credit Specialist Ed Bell to start us off on credit risk management best practice and common examination issue. Next slide.
Thank you, Jessica. Given the dynamic credit risk environment that has occurred over the past few years and the current uncertain economic outlook, the next few slides will address some approaches to credit risk assessment, risk monitoring, and risk management with a focus on corporate governance and board oversight, along with best practices that are often utilized at well-run credit unions. Each director has the responsibility to ensure that their credit union is operated in accordance with applicable laws, regulations, bylaws, board policies, and sound business practices in order to provide credit union services to members at reasonable costs and return a fair dividend to the shareholders. At the end of the day, boards of directors need to be able to make informed decisions about the strategy, direction, and risk profile at their credit union. Next slide, please. Before diving into the different risk management approaches, it's important to start with a few key concepts, specifically risk appetite, risk tolerance, and risk capacity. Risk appetite generally refers to the amount and type of risk that the board of the credit union is willing to accept in pursuit of its strategic and business objectives. The risk appetite can be formal or informal, depending on the level of sophistication of the credit union. However, in all cases, the risk appetite is expected to be well understood and guide the risk-taking activities of the credit union. Additionally, the risk appetite of the credit union can never exceed the credit union's risk capacity. Risk tolerance measures the maximum amount of risk to be taken in a given area, credit risk, for example. Risk tolerances may exceed the board's risk appetite in some cases, but would never exceed the credit union's risk capacity. Risk capacity refers to the ability of the credit union to take on risk without jeopardizing its financial stability. For credit risk, the risk capacity will largely be driven by the sustainability of core recurring earnings, the level of the allowance for credit losses, and the net worth position of the credit union. The amount of risk that a credit union takes on should never exceed its risk capacity. These three concepts are particularly important for boards of directors to understand. When reviewing risk assessment and risk monitoring reports, the board may consider whether the risk levels are consistent with the board's risk appetite and within the board's risk tolerances and the credit union's capacity to absorb risk. The tools that we are going to discuss on the following slides all provide unique ways of assessing credit risk and should not be construed as regulatory guidance. No individual approach to assessing and monitoring risk will provide the complete picture. However, when used in conjunction with each other, the board can gain a greater understanding of the credit risk profile of their credit union's loan portfolios, which would inform the board's strategy and policy decisions. Next slide, please. There isn't a one-size-fits-all approach for credit risk assessment and risk monitoring. However, the board reporting at well-run credit unions typically covers the entire life cycle of the loan portfolio. This would include reporting key information on loan origination, specifically loan origination trends and new lending programs, portfolio level performance, such as the levels and trends of delinquency and charge-off rates by loan or product type at the portfolio level, vintage or static pool analysis. This analysis groups loans within a portfolio by origination date and measures the performance for each pool, which provides a clear understanding of loan performance by controlling for loan growth. Credit concentrations. This analysis includes a review of compliance with concentration policy limits, as well as the levels, trends, and risk metrics associated with the concentrations. Credit score or risk grade analysis. This reporting would cover portfolio level credit score or risk grade information. Periodic board reporting on credit score or risk grade composition and migration within the loan portfolio can provide valuable early insights into the direction of risk within the portfolio. And finally, loss mitigation, workout activities, and charge-offs. This reporting could cover loss mitigation efforts, modifications and workouts, collection activities, as well as loan charge-offs. The information from these reports may be used to inform any strategic decisions that the board needs to make about the loan portfolio and could serve as a resource to inform decisions around revising and updating credit unions' lending policies. A common issue that examiners see when reviewing board reports, as well as senior management level reporting, is a lack of comprehensive information about credit risk. This often manifests itself as a focus on loan originations without adequate attention to the level and trends of credit risk across the entire loan portfolio. While loan origination is the foundation of credit unions, rapid and uncontrolled loan growth, particularly when it is coupled with insufficient risk monitoring, has been a common factor in many troubled or failed credit unions. Additionally, as a general best practice observed in credit unions during periods of changing economic conditions, or when there have been rapid or material changes to the composition of the loan portfolio, reporting on credit risk is more frequent and comprehensive than during periods of slower loan growth in a stable economic environment. A simple framework to think about whether reporting is sufficient is to consider the life cycle of a loan. Board-level reporting ideally would address each step in the life cycle of a loan, from origination, ongoing administration, and final disposition. If any of these steps are missing, then the board might not be receiving comprehensive information about the loan portfolio. We will dive into each of these areas in more detail in the following slides, starting with loan origination trends. Next slide, please. A best practice observed in credit unions with effective credit risk management programs is the boards of directors periodically receiving reports on the credit union's loan origination trends, and the reporting focuses on much more than just loan volume. Reporting on loan originations is typically broken down by loan or product type and ideally provides information on key credit risk metrics. For example, this could include aggregated information on loan interest rates and pricing, the distribution of credit scores, debt to income, and loan to value ratios. Ideally, loan origination trends will also be compared to the credit union's budget to provide the board with variance information as well as updated projections for loan origination volume. In addition to the credit risk information, and arguably one of the most important pieces of information that the board of directors in these credit unions are receiving, is information on underwriting policy exceptions. This could include the number of exceptions, the reason for the exception, and other related information. Loan origination metrics and policy exception data provides the credit union boards with early insight into slipping underwriting standards or changes in the direction of credit risk within the portfolio. This information can allow the board to make adjustments to strategic goals or lending policies before developing risks turn into portfolio-wide issues. Common issues observed during examinations include insufficient reporting on credit risk metrics or lending policy exceptions for new loan originations. Any adverse trends that show up in new loan originations, if not promptly addressed, will flow through to the rest of the portfolio. Careful monitoring of the credit risk profile for new loan originations can be a very effective tool for proactive risk management. Next slide, please. Credit union boards of directors need to remain particularly well informed about the status of new loan programs that the credit union has implemented. The NCUA frequently receives questions from credit unions that are interested in a new lending program or partnering with a third party to originate or acquire loans through new or novel channels. A best practice is to conduct a thorough risk assessment and due diligence before starting any new lending program. The NCUA generally does not take a position for or against any type of lending activity, provided that the lending program is 1. Consistent with the board's risk appetite and strategic plans, 2. Addressed within board policy, including addressing underwriting standards that cover assessing a borrower's ability to repay and the supported provided by collateral, and 3, manage safely, soundly, and in compliance with laws and regulations. The NCUA has observed that lack of due diligence and rapid growth into new or novel lending programs has been a common factor at many troubled or failed credit unions. There have been some cases where examiners have observed instances of inadequate due diligence and poor risk assessments over new lending programs and partnerships with third parties. There have also been instances where examiners observed minimal monitoring and reporting over new lending programs, as well as instances where new loan products were not authorized or addressed within board-approved policies. Examiners also observe occasions where credit unions entered contracts with third parties that obligated them to originate or purchase a given volume of new loans. This can result in the credit union overcommitting capital before the risks of the new lending program are fully understood. Additionally, if the loans do not perform as expected, but the credit union is still contractually obligated to originate or purchase more loans, this can result in significant credit and liquidity problems at the same time. When starting new lending programs, best practices include the establishment and documentation of an initial plan for the lending program that addresses expected loan origination volumes, loan pricing and interest rates, risk metrics such as the composition of credit scores, debt to income, and loan to value for the portfolio, and performance expectations in terms of delinquency and charge-off rates. The plan could also include items such as overhead and administrative expenses associated with the program, both directly and indirectly, and third-party performance expectations. Finally, plans ideally would consider exit strategies and wind-down plans in the event that the new lending program does not perform as expected or economic conditions deteriorate. Once the initial expectations for the new lending program have been established, it is generally prudent for the credit union boards to allocate a relatively low amount of capital to the new program and then closely track how the program is performing in relation to the policy, initial plan, and performance expectations. For example, mapping poorly performing loans to underwriting criteria and other factors can help identify the root causes of adverse trends. After a credit union has gained experience with the program and an initial performance history has been established, then the board and senior management can make informed determination about whether or not to expand, revise, or exit the program. Next slide, please. In addition to monitoring the loan volume and credit risk metrics of newly originated loans, it is imperative that the credit union boards remain informed on the overall level of risk within their credit union's loan portfolio. Loan performance reports are some of the simplest and most widely used ways of measuring portfolio level credit risk. While the format and layout of these reports will vary from credit union to credit union, these reports typically break down the delinquency rates and charge-off rates for the loan portfolio as a whole, as well as for each individual loan type or product that the credit union offers. Delinquencies are usually measured as loans that are 60 or more days past due. This information can be supplemented by more granular data on the age of delinquencies to provide insight into how serious the aggregate delinquency rate truly is. Conversely, monitoring early delinquencies, or loans that are 30 to 60 days past due, is also important because it can provide an early warning indicator of deteriorating credit quality. However, early delinquency data can also be noisy. A common issue that examiners have observed in examinations is a lack of reporting on the severity of delinquencies. Two different credit unions could have the same delinquency rate, but still have drastically different credit risk profiles, depending on the severity of delinquencies at each credit union. Another type of informative reporting is delinquency roll rates, which track the movement of loans between different stages of delinquency. This can provide insights into whether the direction of where loan charge-offs are heading. It can also provide very valuable information about the effectiveness of loan workout and collection programs. Conversely, reporting on cure rates can be a useful way to measure the performance of loan servicing. Reporting on delinquency trends is just as important as reporting on the levels of delinquency. This would usually cover quarter-to-quarter changes, year-over-year changes, as well as longer timeframes such as 3 to 5 years. Including longer-term trends within board reporting can help set the current loan performance within a broader historical context, which can be more meaningful when making strategic decisions about the direction of the credit union. Unfortunately, loan delinquency reports can also misrepresent or understate risk in certain circumstances. The excessive use of skip-a-pays, partial pays, or manually adjusting system due dates can mask loan performance issues. Additionally, newly originated loans typically have fewer performance issues than seasoned loans. So if a loan portfolio has grown rapidly, the delinquency rate may be low simply because there is a large volume of newly originated loans within the portfolio. Next slide, please. Effective board reporting also addresses the level and trend of loan charge-offs for the portfolio as a whole and for each loan or product type. While it is not an explicit regulatory requirement, the industry standard timeframes for charging off consumer loans not secured by real estate are 120 days for closed-end and 180 days for open-end loans. Under generally accepted accounting principles, or GAAP, charge-offs or write-downs for all loan types should occur when the loan or a portion of the loan is deemed uncollectible. It is important to understand that just because a loan has been charged off for accounting purposes does not mean there is no potential recovery value, or that the credit union can't still try to collect on the loan. In accordance with GAAP, loans should be charged off in a consistent and timely fashion, which should be outlined in the credit union's charge-off policy. Recoveries can always be booked in the future if warranted. A lack of timely or consistent loan charge-offs is a commonly observed exam issue. Effective credit union policies clearly outline how and when delinquent loans will be charged off. Delaying these charge-offs understates loss rates, which can result in the credit union under-reserving for loan losses. Additionally, it provides boards of directors with inaccurate information, which can result in poor or uninformed strategic decisions or policy choices. Loan charge-off reporting is critical for understanding whether or not the credit union is still operating within the board's risk appetite. The information is also necessary for determining whether or not the allowance for credit losses is sufficient, whether or not more resources need to be allocated to the loan modification, workout, and loss mitigation programs, or whether or not underwriting or loan pricing standards need to be revised. Similar to delinquency rate reporting, loan charge-off reports can also misrepresent or understate portfolio level credit risk, particularly during periods of rapid loan growth. Rapid loan growth has been a common factor at many troubled credit unions. This is also why it is critical to look at credit risk through multiple different lenses. Next slide, please. One method to mitigate the risk of delinquency and charge-off rate reports, understanding credit risk, is performing loan portfolio vintage analysis, which is also referred to as static pool analysis or cohort analysis. Vintage analysis controls for loan growth, meaning that credit unions can obtain a clearer picture of loan performance. Importantly, vintage analysis can help identify and measure risk that can be missed by the delinquency and charge-off reports that were addressed on the prior slides. Vintage analysis can be used to look at a wide variety of loan performance factors to assess credit risk, but delinquency rates and cumulative loss rates are some of the more common factors that are used. This type of analysis can provide the board with an early warning indicator of credit quality deterioration before it becomes apparent in portfolio level performance reports. For example, if the performance associated with recently originated vintages is slipping, that could prompt discussions about whether policy exceptions need to be limited or underwriting standards need to be revised. Next slide, please. This slide provides a simple example of a vintage analysis. The x-axis is the months from origination, and the y-axis is the cumulative loss rate. The graph breaks down each vintage into the year it was originated. However, vintage analysis often uses more granular timeframes like origination quarter. Looking at the 2020 vintage, you can see the losses initially increased, but then leveled out, with the cumulative loss rate nearing 2.5% at 48 months from origination. Moving on to the 2021 vintage, there are only 36 months of data. However, the vintage has consistently performed better than the 2020 vintage. Based on the performance so far, it's reasonable to assume that the 2021 vintage will continue to have a lower cumulative loss rate. However, it looks like issues are beginning to occur within the 2022 vintage. The cumulative loss rate is consistently higher than the 2020 and 2021 vintages, and the loss rate is accelerating faster. This trend appears to be even worse with the 2023 vintage, which is the light blue line. While the 2023 vintage might be a relatively small portion of the overall loan portfolio, if those trends continue with new originations, the credit quality of the overall loan portfolio will deteriorate over time. Trends like this can prompt questions such as, Was there a change in underwriting standards during 2022? Are loan exceptions increasing? Has loan pricing been updated to reflect the increasing loss rates? Do underwriting standards need to be tightened to reverse loan trends? In cases like this, board and senior management level discussions would focus on the root causes of the issue. Once the root cause has been identified, plans are put in place to remediate the issue, and progress with the plan is periodically reported to the board. Alternatively, if the increasing loss rates are consistent with the board's strategy, for example, expanding credit offerings to higher risk borrowers, then this could lead to a discussion about whether the increasing loss rates are still within the board's risk appetite and the credit union's risk capacity. If that is the case, then no mitigating action may need to be taken. It is all dependent on the given situation. There have been instances where there were material changes to the composition or performance of credit union loan portfolios, but there was no corresponding change to the credit union strategies or policies. When there are material changes, particularly when those changes are poorer than expected loan performance, board and management discussions would ideally address whether corrective action needs to be taken to remediate the issue. With that, I will turn it over to Senior Credit Specialist Simon Herman to discuss concentration risk. Next slide, please.
Thank you, Ed. Our next area of focus will cover risk assessment, monitoring, and management of credit risk concentrations within the loan portfolio. The proper management of concentration risks is critical to the safe and sound operation of credit unions. Elevated and poorly managed loan concentrations have been a common denominator in many credit union failures. Credit risk concentrations are ultimately based on common or correlated risk factors, which, in times of stress, will have an adverse effect on the creditworthiness of each underlying borrower making up the concentration. Concentrations within the loan portfolio can increase the variability of losses. For example, the graph on this slide shows the potential distribution of losses within a hypothetical loan portfolio. The expected losses within the loan portfolio will be supported by the allowance for credit losses. The unexpected losses, however, which are the losses that occur over and above the expected loss amount, will primarily be supported by net worth. Higher credit risk concentrations will result in higher potential loss variance within the loan portfolio, particularly in times of economic stress, resulting in the need for higher net worth. As a matter of best practice, the risk capacity of a credit union and its board's risk appetite and risk tolerances would drive how concentration risks are managed. Next slide. There is not a one-size-fits-all approach when deciding what concentrations a credit union should focus on. A credit union needs to be able to assess and understand what the common or correlated risk factors are across the loan and investment portfolio. Those risk factors will then drive the selection of concentrations that need to be measured and reported. For example, consumer credit cards might behave similarly to unsecured consumer term loans. Since both loan types are unsecured, it could be reasonable to think that the same risks that would lead a borrower to default on their credit card balances might also impact their willingness or ability to repay their other unsecured loans. Some other examples of common credit risk concentrations within loan portfolios include the loan or product type, the collateral type, the origination channel, such as indirect originations, participations purchased, or eligible obligations, the credit risk profile, such as risk grade, credit score, or loan to value, the geographic location of the borrowers, and the industry or common employer. Next slide. After the relevant concentrations and risk factors have been identified, the next step is to establish well-supported concentration limits. Concentration limits are generally based on both quantitative and qualitative analysis, established within a board-approved concentration risk policy and measured in relation to the credit union's net worth. having unsupported limits is a frequently observed issue during examinations. Some questions to consider when establishing concentration limits are, what is the credit union's capacity to absorb risk? This would generally be driven by the credit union's recurring earnings, allowance for credit losses, and net worth position. What is the board's risk appetite and risk tolerance? What are the strategic objectives of the credit union? And what is the ideal loan portfolio mix? Additionally, it's also important to consider how much could a loan concentration grow before a concentration limit was breached, or what would the structure of the balance sheet look like if the credit union was to approach its various concentration limits? Stress testing and scenario analysis are very useful tools for analyzing concentration limits. This type of analysis does not have to be particularly complicated. For example, if the credit union were at a relevant concentration limit and there was a material increase in the loss rate associated with that concentration, would the credit union be able to absorb those losses while remaining financially stable and viable? Under this type of scenario analysis, the potential losses could be compared to the credit union's earnings, allowance for credit losses, and net worth. If the potential losses would have a negative impact on the financial stability of the credit union or exceed the board's risk appetite, then the concentration limit is probably too high. A common risk management issue observed by examiners is taking a set and forget approach to concentration limits. The economy changes, the loan portfolio changes, and risk profiles change. So just because the concentration limit was reasonable 5 years ago doesn't necessarily mean that it's still reasonable today. Concentration limits are ideally reevaluated and updated periodically. Another best practice when establishing concentration limits is to utilize higher level portfolio limits in combination with more granular sublimits. For example, a credit union might establish a limit of 300% of net worth for indirect vehicle loans, but then establish sublimits for the amount of loans from any individual dealer, the amount of loans to borrowers with low credit scores, or the amount of loans with higher loan-to-value ratios, etc. Next slide. Once the relevant concentrations have been identified and risk limits have been established, the next items to consider are what information to include in board reports and how frequently to conduct reporting. Many credit unions provide quarterly reporting on concentration risks to the board. This is a reasonable starting point, but the frequency would depend on how risky the portfolio is, how stable the portfolio is, and the economic conditions and outlook. While the level of detail in board concentration reports will vary from credit union to credit union, this type of reporting generally addresses, 1, the level and trends of concentrations. Trending information is very important to include because without historical context, the current levels provide less useful or actionable information. 2, the risk profile of the concentrations. This could include information on performance metrics, credit scores, risk grades, or collateral values. The point is ultimately to understand and be able to make informed decisions about risk. There have been situations where the level of concentrations have not materially changed, but there has been a material change in the risk profile of the concentration. In cases like this, the board may need to reevaluate or lower the concentration limit to reflect the new risk information. 3, compliance with concentration policy limits. A best practice is also to include early warning triggers that are not a hard limit, but that trigger escalation and discussion prior to actually reaching one of the credit union's concentration policy limits. And 4, in the event that a concentration limit has been exceeded, board reporting typically would also address plans, timelines, and progress for remediating the exception to the policy limit. A word of caution on concentrations risk. There have been instances observed by examiners where the board or management at a credit union was primarily focused on growing the loan portfolio. So each time a concentration limit was reached, the policy limit was simply increased to allow for more loan growth. Concentration limits are put in place to protect the viability of the credit union. This doesn't mean the concentration limits can't ever be raised, But if they are raised, the decision is ideally discussed, analyzed, and well supported. Next slide. The next key piece of information that both boards of directors and senior management may consider is portfolio-level credit score analysis. This type of analysis and reporting can potentially be combined with or supplement concentration risk reporting. Before diving into the details of credit score analysis, though, it's imperative to fully understand what credit scores can tell you about the credit risk within a loan portfolio, and conversely, what credit scores cannot tell you. To start with, the NCUA does not endorse any credit score provider or any particular credit scoring model. There are multiple credit score providers and a wide variety of different credit scoring models. It is very important to understand that a score provided by one model does not necessarily reflect the same risk as the score provided by another model. It's also important to understand that consumer credit scores are a relative measure of the risk that an individual will default on a loan. Credit scores are not an absolute measure of the risk of default. This means that the probability that a borrower with a given credit score defaults on their loan will change over time. For example, the probability of default for a borrower with a 660 credit score in 2020 will not be the same as it is today because the economic conditions are different. Additionally, credit scores do not necessarily tell you how much money you should expect to lose on a loan. Credit scores tell you the relative risk that a borrower will default, not the magnitude of a loan loss. The probability that a borrower will default on a loan will also depend on the type of the loan and the amount and value of collateral securing the loan, if any. Finally, it is very important to understand that the risk associated with credit scores is not linear across credit score ranges. For example, the change in the probability of default between a 620 and a 660 credit score could be much larger than the change in the probability of default between a 740 and an 800 credit score. Next slide. We will start with portfolio-level credit score reports. As with everything that we have discussed so far, there is not a one-size-fits-all approach to these reports. However, these reports will generally include information on weighted average credit scores, performance metrics, layered risks, and loan concentrations. These reports can be put together based on borrower credit scores at origination, or they can be based on updated credit scores that are periodically refreshed. Weighted average credit scores are a frequently used form of board-level reporting. These reports usually show the trend in weighted average credit scores over time for new originations and for outstanding portfolios by loan type. Weighted average credit score reports are very easy to read and can show high-level credit risk trends. However, these reports can also misrepresent credit risk, so they shouldn't be relied on in a vacuum. As discussed on the prior slide, while credit scores are a linear scale, the risk associated across credit score ranges is not necessarily linear. For example, the average credit score for a portfolio might be 720, even though the default rate across the portfolio could be higher than would be expected for borrowers with a 720 credit score. This happens when there is a wide range of credit scores across the portfolio. The higher probabilities of default associated with lower credit score ranges can result in higher portfolio-level probabilities of default than would be expected by looking at the weighted average credit score in isolation. Portfolio breakdowns by credit score bucket and performance metric are another type of informative reporting. These reports would typically break down each loan category into credit score buckets along with the associated performance metrics such as delinquency and charge-off rate. This can provide much more detailed information on the composition and risk profile of the loan portfolio. Additionally, if the delinquency or loss rate for certain credit score buckets are higher than expected, this can prompt discussion about whether underwriting standards or loan pricing need to be adjusted, or if additional resources need to be allocated to the loss mitigation function, etc. Not updating minimum scores or adjusting credit score underwriting requirements based on changing default and loss rates is a relatively common issue. Portfolio-level credit score reporting can also be presented in a concentrations risk format. For example, indirect vehicle loans to borrowers with a given credit score bucket could make up a concentration that warrants monitoring and reporting to the board. Finally, layered risks is another type of report that management and boards may wish to consider. Layered risk reports aggregate multiple risk factors, which can provide insight into the highest risk parts of the loan portfolio. This could include stratifying the portfolio by credit score, debt to income, and loan to value data. Since credit scores generally provide insight into the probability of default, debt to income provides insight into the ability to repay, and loan to value provides insight into loss given default. Stratifying the portfolio by these metrics can provide useful information about the sections of the portfolio with the highest risk of loss. Next slide. Another useful tool that many well-run credit unions use is credit score migration analysis. Migration analysis can be completed in different ways. However, the analysis can generally provide a more holistic view into how the probability of default is changing within the portfolio by obtaining updated credit scores on a periodic basis to assess whether the credit quality of the portfolio has improved or deteriorated, and to assess default rates by credit score. Periodically obtaining updated credit scores is very useful for proactive risk management because a borrower's risk profile can deteriorate long before the borrower becomes delinquent on their loans with the credit union. For example, a borrower might become delinquent on loans held at another institution, or they may begin running up substantial credit card balances. That information would be reflected in the borrower's updated credit score before it would show up in the credit union's loan performance metrics. This information can help the board and senior management make better decisions about how to manage the credit risk within the loan portfolio. Next slide. This slide provides an example of a one-year credit score migration analysis for a hypothetical $200 million loan portfolio. The top analysis is outlined in dollars, while the bottom analysis is shown in a percentage format, but both tables are based on the same hypothetical data. So, for example, the largest section of the portfolio was just over $61 million. This section of the portfolio fell into the 661 to 720 credit score bucket. During the following 12 months, $13.5 million in loans to those borrowers saw credit score improvements, $35 million saw no change in credit score, $12.25 million saw their credit scores decline, and $650,000 were charged off. Moving to the percentage table, you can see that the loss rate by credit score bucket over the year. As outlined in the table, the loans to borrowers with a credit score over 620 are all performing relatively well. However, there are some clear performance issues for borrowers with a credit score of 620 or below. The charge-off rate for the 581 to 620 credit score bucket was 10.3%, while the charge-off rate for the 580 and below bucket was 22.5%. Moving to the summary information, you can see that there has generally been a deterioration in loan quality across the portfolio. While the credit scores associated with 39.15 million of loans improved, the credit scores associated with 51.5 million of loans deteriorated. Approximately 17% of the portfolio is comprised of borrowers with a credit score below 620, which also represents 113% of net worth. Given the information's migration analysis, the board and senior management may need to have discussions about the credit quality of the loan portfolio. Poorly performing loans represent over 100% of the credit union's net worth, which is concerning, along with a broader negative credit score migration across the portfolio. The board may need to have management identify the root cause of the issues and then develop a plan to reverse the negative trends in the portfolio. In a situation like this, the board would ideally review and approve the plan and then receive periodic update reports as the plan is executed. Since the majority of the loan performance issues are for borrowers with a credit score of 620 or below, the plan might address revising underwriting standards, updating loan interest rate pricing, or to more accurately reflect risk, improving loan modifications or workout procedures, and allocating more resources to the loss mitigation function. Elevated charge-off rates do not necessarily mean that the credit union needs to stop making loans to all of these borrowers, but the credit union may need to update its risk management processes to reduce the loss rate. That being said, the loss rate for the sub 580 credit score bucket is quite elevated. Those loans only represent 2.8% of the loan portfolio, but are responsible for 23.5% of the loan losses. The credit union might not be able to make up for those losses through adjustments to interest rates alone, since federal credit unions currently have an 18% rate cap. As such, other options may need to be considered to mitigate the losses. Next slide. The last credit scoring topic that we will cover is risk-based pricing and profitability analysis. Risk-based pricing ultimately refers to adjusting the interest rates the borrowers pay to reduce the risk of default and loss on the loan. Higher credit quality borrowers would typically pay lower rates, while lower credit quality borrowers would typically pay higher rates. Risk-based pricing is a very important topic for risk management because it helps reduce adverse risk selection. Adverse risk selection in lending can occur because higher credit quality borrowers have more financing options available to them, while lower credit quality borrowers do not. So if the loan pricing offered to a high credit quality borrower is not competitive, that is reflective of the borrower's risk profile, then that high credit quality borrower is more likely to obtain financing elsewhere at a lower rate. Conversely, a lower credit quality borrower is more likely to obtain financing at an institution that does not utilize risk-based pricing because those borrowers are less likely to be able to obtain financing elsewhere, or if they can obtain financing elsewhere, it will be at a higher rate. Adverse risk selection can bias the loan portfolio towards borrowers with a higher probability of defaulting on their loans. Risk-based pricing in consumer lending is often driven by the borrower's credit score, but it can incorporate other factors such as the borrower's debt-to-income ratio, their employment history, or collateral support. Risk-based pricing would ideally be accompanied by a profitability analysis, and this analysis would typically be reflective of the probability of default and expected losses on the loan, consider servicing and overhead expenses associated with administering the loan, incorporate the cost of funding into the loan's pricing, and include a risk premium that reflects the risk profile of the borrower. When risk-based pricing is not utilized, potential members may not be able to obtain funding through the credit union at all. However, when done correctly, risk-based pricing can allow credit unions to serve a much wider array of members. If loan performance is beginning to deteriorate and earnings are declining due to the need for higher than anticipated provisions for loan losses, then the board may need to review the credit union's approach to loan pricing and profitability analysis and consider whether revisions are necessary to reflect changes in credit risk. With that, I will turn it over to Senior Credit Specialist Walanda Hollins to discuss loss mitigation and workout programs. Next slide.
Thank you, Simon. Up until this point, we have largely focused on assessing, measuring, and managing risk at a portfolio level. However, when a borrower becomes delinquent or is facing other financial difficulties, the credit union will need to proactively work to resolve the issue and mitigate potential loan losses. Having a strong loss mitigation function with clearly established policies and procedures is a critical piece of the risk management framework. These programs typically start with the initial borrower contact shortly after a loan becomes delinquent, with documentation of the initial contact and follow-up contacts, and escalation as necessary to minimize any potential losses. Depending on the situation, these loss mitigation arrangements can include deferrals and repayment plans, payment extensions and maturity extensions, temporary forbearance, longer-term modifications and loan bifurcation, discounted payoffs and short sales, surrender and deed in lieu arrangements, or repossession, foreclosure, and litigation. As a matter of best practice, credit unions with effective loss mitigation programs periodically provide their boards with reports that address how well the loss mitigation program is functioning. This can include key performance indicators and trending information that covers the number and percentage of contacts that were made on time, as well as the type of contacts that were made, the number or amount of modified loans that are not performing, the amount of debt that was recovered or brought current within the period, and the average days to recover a debt, etc. When corresponding with borrowers, these credit unions typically ensure that the borrower understands all the payment options and other potential products that may be available to them. Next slide, please. Credit unions can use loan accommodations, modifications, and other workout arrangements to help borrowers overcome temporary financial difficulties such as loss of job, medical emergency, or change in family circumstances such as the loss of a family member, as well as longer term financial difficulties. However, these arrangements generally consider and balance the best interests of the borrower and the credit union. Under Appendix B to Part 741 of the NCUA's Rules and Regulations, credit union boards and management must adopt and adhere to an explicit written policy and standards that control the use of loan workouts and establish controls to ensure the policy is consistently applied. The policy should define eligibility requirements. That is, under what conditions the credit union will consider a loan workout. This also includes establishing limits on the number of times an individual loan may be modified. It should ensure the credit union makes the loan workout decisions based on the borrower's renewed willingness and ability to repay the loan, which also requires documenting the determination that the borrower is willing and able to repay the loan. And establish sound controls to ensure loan workout actions are appropriately structured. Additionally, the credit union's risk management framework would benefit from including thresholds based on the aggregate volume of loan workout activity, which trigger enhanced reporting to the board of directors. This reporting enables the credit union's board of directors to evaluate the effectiveness of the credit union's loan workout program, understand any implications to the organization's financial condition, and make any compensating adjustments to the overall business strategy. Modification and workout policy ideally establishes the potential duration of modifications, the minimum interest rate, and the maximum amortization period. This is often done through a waterfall structure that outlines each step that will be considered before proceeding to the next step of the workout. A common issue surrounding loss mitigation and modifications is not reporting on these activities to the board of directors. The board clearly needs to remain informed on the success of loss mitigation and workout activities, which is also a requirement under Appendix B to Part 741 of the NCUA's Rules and Regulations. Poorly structured loan modifications are another common issue. There have been cases where credit unions have made permanent modifications to loans to address temporary borrower problems. This has resulted in some borrowers having significantly below market interest rates or extended repayment terms well after the financial difficulties that the borrower was facing were resolved. Next slide, please. We will conclude this webinar with a short discussion on credit risk governance. Governance ultimately rests with the board of directors and generally covers the strategies, policies, and oversight of the credit union, including the overall framework for identifying, measuring, and managing risk. As we addressed at the start of this presentation, each director has the responsibility to ensure that their credit union is operated in accordance with applicable laws, regulations, bylaws, board policies, and sound business practices in order to provide credit union services to members at reasonable cost and return a fair dividend to the shareholders. At the end of the day, boards of directors need to be able to make informed decisions about the strategy, direction, and risk profile of their credit union. Next slide, please. When thinking about credit risk governance at a very high level, credit union boards of directors may consider the following questions. Does the strategic plan and budget address loan growth and related resources? Are board approved policies up to date and reflective of current lending activities and any changes to the risk profile of the loan portfolio? Does loan portfolio monitoring and board reporting comprehensively address credit risk, compliance with strategy and policies, policy exceptions, and remediation plans if the credit union is operating outside of board policy requirements? Ideally, boards of directors will periodically obtain independent credit risk reviews of their loan portfolios, which would include both consumer and commercial loan portfolios. While management reporting generally represents the preponderance of board reporting, obtaining an independent assessment of credit risk will provide assurance that the internal risk reports that the board receives are accurately reflecting and comprehensively reporting on credit risk. Finally, boards at credit unions with comprehensive credit risk governance programs consider whether their credit union's lending functions are subject to periodic internal audits. Internal audits are not the same as independent credit risk reviews. Internal audits would generally cover compliance with board-approved policies and regulatory requirements. However, similar to independent credit risk reviews, internal audits provide an independent assurance that the credit union is operating in compliance with the governing policies that have been established by the board. Next slide, please. We've covered a lot of risk management concepts today, with a heavy focus on monitoring the condition of the loan portfolio and making strategic and policy decisions to proactively address and remediate emerging issues. There isn't a one-size-fits-all approach to credit risk management, and each institution will need to tailor its risk management framework to the size, complexity, and risk profile of its portfolio and lending programs. However, there are some thematic concepts that will apply to every credit union, which includes understanding risk appetite, risk tolerances, and risk capacity. Loan portfolio monitoring and board reporting would ideally comprehensively address risk and cover the entire lending process from loan origination to final disposition. Since no single method of monitoring risk is perfect, boards of directors would generally benefit from receiving reports that look at credit risk from multiple different perspectives. When risks begin to emerge, both the board and management would benefit from acting proactively to remediate the issues before they develop into more significant problems. Throughout this presentation, we have avoided focusing on any specific type of lending or loan product, but have rather focused on principles that can be applied to the vast majority of lending products that are provided by credit unions. Additionally, the takeaway from this presentation should not be that credit unions need to curtail their lending programs, but rather that lending programs need to be conducted in a safe and sound manner and managed appropriately for the size, complexity, and risk profile of the lending activities conducted. Next slide, please. This slide provides some additional credit risk related resources that credit union boards and management teams may find useful. The presentation materials can be downloaded and the resources can be referenced through the embedded links. Thank you for joining us today. I will now turn it back over to Associate Director Nagi Khalid to moderate the question and answer session. Next slide.
Thank you, Alonda. At this point, we will open it up for the Q&A session. As a reminder, you may submit questions using the Q&A feature at the bottom right corner of your WebEx console. To submit a question, simply click the Q&A button and type your question to the box provided and then click Send. With that, we have a number of questions that have already been submitted, so we'll start with some of those. Our first question is for Simon. This presentation has covered a lot of very detailed information. Can you provide some perspective on the level of detail that should be in the board reports?
I'd be happy to try and answer that question. As with everything we've discussed today, there really isn't a one-size-fits-all answer. The board needs to receive sufficient information to be able to fully understand the risks to the institution. However, you don't necessarily want to just bury the board in graphs and data tables either. So this is where I think executive summaries and narrative reports become very important. My general suggestion would be to summarize and highlight the key information for the board and then attach the more detailed reports as appendices that the board can reference for more information if needed. That concludes my response.
Thank you, Simon. Our next question actually goes back to Simon. We received several questions about the level of due diligence on third-party lending partners that examiners expect to see. Can you help provide some perspective on this issue?
Thank you for the question. Conducting due diligence on third parties before selecting and entering into third-party relationships is an important part of sound risk management. The NCUA's eligible obligations regulation also includes a requirement to conduct due diligence on the seller of loans and other counterparties to the transaction prior to purchase. Appropriate due diligence would generally include assessing the third party's ability to perform the activity as expected, adhere to the credit union's policies related to the activity, comply with applicable laws and regulations, and conduct the activity in a safe and sound manner. Third-party due diligence is typically commensurate with the level of risk and the complexity of that third-party relationship. So when conducting due diligence, credit unions may wish to consider items like the financial condition of the third party, experience, resources, and qualifications of the third party, legal and regulatory compliance, such as whether the third party can complete their services in compliance with applicable laws and regulations, third-party reliance on subcontractors or contractual arrangements with other parties, information security of the third party, particularly when sensitive member information is involved, management information systems and the reporting abilities of the third party, and potentially appropriate insurance coverage. That isn't a comprehensive list, and not everything will necessarily apply, but it's a reasonable starting point for conducting due diligence. That concludes my response.
Thank you, Simon. And I saw several questions come in regards to the webinar slides. And thank you all for submitting those questions. The slides can be downloaded by going to the registration page of the webinar. You'll just need to re-enter your information in order to download the slides. With that, next question is for Walanda. The presentation indicated that the typical charge-off timeframes for most consumer loans ranged from 120 days to 180 days. Is that a regulatory requirement?
Thank you for the question. The NCUA does not require any specific charge-off time frame. However, the NCUA's regulations generally require charge-offs for loan and lease losses to be made timely and in accordance with generally accepted accounting principles, or GAAP. Under GAAP, write-offs on financial assets need to be recorded in the period in which the financial assets are deemed uncollectible. Well-run credit unions generally have a board-approved charge-off policy that addresses how and when loans will be evaluated for collectability. These policies typically address much more than just the delinquency status of loans. For example, the charge-off policy could address a skip where the borrower has stopped paying and cannot be contacted. Loans in bankruptcy, fraudulent loans, or loans to deceased persons, etc. But nevertheless, delinquency is a widely used metric used to determine whether or not a loan has become uncollectible. If a borrower has been delinquent by 4 to 6 months, the likelihood of collection can be quite low. This is why the 120 and 100-day benchmarks are standard industry timeframes for charging off loans. That concludes my response.
Thank you, Walanda. Next question is for Ed. Can you provide some examples of other common performance metrics that could be tracked as part of a vintage analysis?
Of course. As we mentioned, delinquency rate and loss rates are very common metrics to track within vintage analysis. However, you can also track items like recovery rates, utilization rates, average balances, gross or net yields, roll rates, etc. The metrics tracked will really just depend on what the credit union is trying to evaluate. For example, a credit union might want to run a custom vintage analysis to help evaluate a change to their underwriting policy. Using a pre- and post-change vintage analysis to evaluate key performance metrics could help provide insight into how effective the policy change was. That concludes my response.
Thank you, Ed. Next question, I'll go back to Walanda. When working with borrowers that are struggling financially, does the NCUA prefer any certain type of loan modification over others?
Thank you for the question. No, the NCUA does not have a preferred type of loan modification. provided that the modification is based on the renewed willingness and ability to repay the modified loan, and the modification is appropriately structured. That concludes my response.
Thanks, Valanda. Next question, I'll go to Jessica. I understand getting an independent review of a commercial loan portfolio, but are independent reviews also expected for consumer loans?
Thank you for the questions. This really comes down to the corporate governance and internal controls. Ideally, boards are verifying that risks are accurately and comprehensively reported to them. Reviews can be conducted by independent internal staff or outsourced to independent third parties. The nature of the credit union review system will vary based on the size, complexity, and the risk profile of the credit union, and provide the board with an objective, independent, and timely assessment of the overall quality of the loan portfolio. Credit risk reviews are typically conducted on an annual basis, but that time frame can vary depending on the need of the board. These reviews would usually cover all segments of the loan portfolio that pose a significant credit risk to the institution. The interagency guidance on credit risk review system that came out in May of 2020 would be a good resource to consult for additional information on this topic. That concludes my response.
Thank you, Jessica. I'll go back to Simon for the next question. Can you explain what you meant when you said that a portfolio's weighted average credit score could misrepresent risk?
Thank you for the question. I'd be happy to try and explain that a little bit more. Looking at the weighted average credit score and how it is trending over time can be a very useful metric for measuring and monitoring credit risk. It's just important to understand that the risk associated with a weighted average credit score is not necessarily the same as the risk associated with a borrower with the same credit score. Since probabilities of default tend to be much higher at the lower end of the credit score range, you can run into a situation where the probability of default associated with the weighted average credit score is higher than would be expected for a borrower with the same credit score. This is why it's also important to measure the composition of credit scores across the loan portfolio instead of only looking at the average. Measuring and reporting on subprime concentrations in particular could be a very useful metric that can complement reporting on the weighted average credit score. That concludes my response. Back to you, Nagi.
Thank you, Simon. And we have time for one last question. I'll go back to Jessica on this one. Do you have any recommendations on best practices that small or mid-sized credit unions can utilize when trying to diversify their loan portfolios through loan participations?
Thank you for the questions. The specific regulation requirements covering loan participations can be found in Section 701.22 of the NCUA's Rules and Regulations. Under Section 701.22 of the NCUA's regulations, credit unions that purchase loan participations should establish and adhere to loan participation policies that are reviewed and approved by the board. This policy typically establishes the type of loans that credit union can purchase and the market areas that credit union will consider purchasing participation in. In addition to this, the policy ideally establishes underwriting standards that address a number of the different aspects, including conducting due diligence on the selling institution, making an independent assessment of the borrower's ability to repay the loan and the support provided by the guarantors, and conducting a comprehensive analysis of the support provided by collateral. Additional best practices including considering does the credit union understand the market that the borrower is operating in? How much of the loan is the lead lender retaining on their books? Is the lead lender operating an originate-to-sell model, or are they retaining a substantial portion of the loan? How will the relationship be managed if the lead institution or the loans does not perform as expected? How will the purchasing credit union deal with the borrowers or replace the servicer if needed? What authority does the lead lender have to make modification to the loan agreement? There have been situations where credit unions that were purchasing loan participations did not understand the comprehensive financial conditions of the borrower, guarantor, and related entities. There have also been situations where purchasing credit union did not understand the market dynamic of the areas they were purchasing participation in, or the factors impacting collateral values. These issues have arisen due to over-reliance on the representation made by the lead institutions, where the purchasing credit unions did not conduct sufficient due diligence or independent underwriting prior to purchase. This has resulted in unexpected losses and protracted legal costs when the loan participation did not perform as expected. That concludes my response.
Thank you, Jessica. Can we get to the next slide, please? So I'd like to thank everyone for attending the webinar today. That concludes our allotted time. If we didn't get to your question, or if you have other questions that you have in mind, you can still contact us at eimail@ncua.gov as listed on the slide deck. Thank you so much and have a great day.